The stress leading up to retirement can be terrible. You go from having job security, making great money, and having a routine to absolutely nothing overnight. And that first Friday that nothing hits your bank accounts can make even the strongest people have a heart attack. So, what do you do after the paychecks stop? Where do you get the money from and how do you make it last? Well, today we're going to talk about which accounts to take from in retirement. Hi, my name is Chris Sobolski, and I help people like you retire with dignity, purpose, and your eyes set on the future. If you're new here and if you have a question, please drop a comment below and please like and subscribe. Now, the easiest answer of where does money come from in retirement is usually Social Security or pensions. If you have a pension or you're the right age to take Social Security and that meets all of your income needs, fantastic. But for most people, those funds only cover part of our income needs. Now, we're going to talk about something called the income gap today. And the income gap is determined by how much guaranteed income you have coming in each month, subtracted by your total income needs. So, say you have 30K coming in a year from Social Security or pensions, but you spend 120K, well, then you have a 90K income gap. Make sense? So to fill that gap, should you pull it from your taxable account? Should you pull it from your Roth IRA, your 401k? Where does it come from? While each of these account types have their own benefits, choosing the wrong account can have a surprisingly large impact on the long-term success of your retirement plan. Now, why is that? Well, it's taxes, of course. You already knew this because each account type has different tax implications. And those tax implications can snowball in a good way or a bad way over your lifetime. So let's start with the basics of how each account type works. First, it's the most common account. It's usually the largest account. It's people's 401k or their traditional IRA. When you put money into this account, you got a tax deduction, meaning you made 100K a year, you put 10K into your 401k, you got taxed as if you only earned 90K. That 10K was a write-off. So your traditional IRA or 401k also grows tax deferred. Now, in retirement, as you pull the money out, you pull it out at ordinary income rates, or like a W-2 is how it's taxed. So at its core, the traditional IRA or 401k is what we call a pre-tax account. You want to have put money in at a higher tax bracket while you're working, and then theoretically pull it out, or ideally pull it out at a lower tax bracket. So at its core, the traditional IRA or the 401k is what we call a pre-tax account. And the ideal is that you want to have put money in at a higher tax bracket while you're working and then pull it out at a lower tax bracket. So let's say during your working years, you're getting taxed at the 24% bracket. Now in retirement, you're spending within the 12% tax bracket. Well, that'd be a huge success because you put money in at a higher rate, you're pulling it out at a lower rate. Congratulations. That's what the 401k or traditional IRA was meant to be. Got it? The story doesn't end there with these pre-tax accounts. While you haven't had to pay any tax up until this point in retirement, until you pull the money out, if you never touch the account, you'll have to start paying taxes on it once you hit the age of 73. That's when your required minimum distributions, or RMDs, come out again. These RMDs can become massive depending on your account size. They start anywhere around, let's call it about 4% when you hit age 73. So think about this. 4% of $1 million, that's 40K that you'd have to pay taxes on. And letting these accounts roll and grow out of control can really trip you up later in your retirement years. Now, we'll come back to this down the line, but the next tax advantage account is called the Roth IRA. With this account, you didn't get a deduction on your taxes when you put the money in, but you do get tax-free growth. This account's considered the best because it's hard to beat tax-free growth, right? And on top of that, this account doesn't need to take out required minimum distributions when you hit age 73. So the final type of account is one that we haven't talked about yet. It's called the taxable account. Now, this one doesn't have any tax advantages when you put money in. The biggest difference with this account is that when you hold the asset for more than 1 year and then you sell it, you take the money out, you're taxed at a different tax table called the long-term capital gains table. See, this table has 3 brackets, 0%, 15%, and 20%, whereas there are 7 federal tax brackets, like when you take money out of your 401k. So these are the 3 types of accounts, and these accounts can hold any asset. So just because you have a CD doesn't mean it needs to go in a taxable account. Or if you want to buy a technology stock, it doesn't have to go into an IRA. Account types don't mean they have to hold specific investments. So let's get back to the income gap. So first we need to know our fixed income sources or guaranteed income sources in retirement. Social Security, pensions, those are the most obvious, right? But we might throw in rental properties or residual business income. And these provide kind of that baseline of guaranteed income. So knowing our income gap then leads us to asking, what's my withdrawal percentage? Withdrawal percentage is simply the income gap divided by your total portfolio value. So let's say in our example here that we have a $30K a year coming in from your guaranteed income, you're spending $20K a year. So we have a $90,000 income gap. Now let's assume that we have $1 million portfolio. Therefore, take 90,000 divided by 1 million, we come up with 9%. We have a 9% withdrawal rate. Make sense? Now, I'm sure all of you have heard about the 4% rule. That's talking about your withdrawal rate, right? So a 4% withdrawal rate is being a safe withdrawal rate to theoretically make your assets last throughout your lifetime. Now, understanding your withdrawal rate can lead to some very important findings. In our example here, we have a 9% withdrawal rate, which is much higher than the 4% withdrawal rate, which, again, is considered that safe withdrawal rate in your early retirement years. So a 9% withdrawal rate might tell us that, hey, you're pulling out way too much money. We need to make some adjustments. So understanding your income gap and then your withdrawal rate are 2 of the most important numbers when building your retirement plan. Okay, so now we have our income gap and withdrawal rate. So where do we pull the money from? Most clients that come to me have their money spread across those 3 different accounts, and you need to know how the account types work and the tax rules surrounding those. But I find that most clients, when they come in, have about 70% of their money in IRAs and 401ks and that pre-tax bucket, then 20% in a taxable account. It's usually a mix of cash or vested stock options. And finally, 10% of that money is in a tax-free Roth bucket. Now, those numbers are shifting through the years as people become more familiar with Roths and are worried about tax rates in the future. So most people come to me and they have that big bucket of money, and usually in their 401k, and they're going, okay, I need to pull out XYZ amount of money according to my income gap and my withdrawal rate. And I've got to have that last for XYZ years. And, look, assuming you're over 59 and a half when you've retired, the IRA, the 401k is a great place to start. And the reason being is that the traditional IRA, that 401k bucket, is being withdrawn at ordinary income tax rates. And so by taking money out today under known circumstances and known tax rates, we can control our taxes. Also, in your early years of retirement, not only do we know our tax rates, but we have a very clear idea of what our goals are. And now it's impossible to know the future or what the next 20 or 30 years hold for you in retirement. But usually in these early years, we know exactly how much we want to spend. What trips you want to take, what cars you want to buy, vacation homes, hobbies, all those things. So our goals are pretty definite in the early parts of our retirement. And therefore, we know or can have a good idea of what our spending is and therefore what our tax rate should be. So that's another reason why we want to attack or withdraw down from this 401k bucket. Now, an added benefit of drawing down from that 401k or traditional IRA is that the larger that account grows, the greater your required minimum distributions are going to be in the future. And these are required minimum distributions, right? We've talked about this. It's not an option when you hit age 73, and it's going up to 75 in the future. But when you hit age 73, you're required to take out a percentage of that account every year. Now, what's the penalty if you don't take money out? Well, it's 50% of whatever your required minimum distribution was supposed to be. So say you're supposed to take out 40K this year, you did nothing. Well, next year, you're still going to have to take out 40K, but you're also going to have to pay a tax penalty of 20 grand. So skipping RMDs is a non-starter. It's not even an option. We're not going to even think about it, okay? So again, think about this account, because if we don't tackle it, if we don't reduce it, if we don't move it into different buckets by doing Roth conversions, whether it's our taxable or tax-free bucket, we're letting this account grow unaccounted for RMDs. And RMDs can come back and bite us in the future. So here's another way RMDs can get us in trouble. Say you need to spend 30K in a year, but your RMD is actually 40K. Well, it's not like you can only take 30K from an account. If we do that, we'll have a $10,000 gap in our RMD and then owe a $5,000 tax penalty. That's ridiculous, right? So taking money out of your traditional IRA first not only helps you with tax control during the current year, but it also helps you avoid potentially higher future tax rates and uncontrollable RMDs. So another issue on top of the RMD issue is that when you take money out of the traditional IRA accounts, it counts as ordinary income. And that can also bump you into the next Medicare tax brackets. Now, if you're married filing jointly, if you have less than $212,000 of income this year, you're paying the standard rate for Medicare. But if you go over that limit, you're going to pay a higher percentage for Medicare for the next 2 years. And I'll show you this chart right here. It shows the different breakpoints for a married filing jointly person and what their income levels could be and their tax brackets and what you would pay for Medicare. And as you can see, the Medicare brackets don't perfectly line up with the tax brackets, but the more you spend or the more income you have, the more your Medicare is going to cost. Think of it like an added tax. And if your RMD is out of control or huge and it automatically pushes you over one of these brackets, well, sorry, buddy, you're paying more for Medicare. So this all comes down to control. Why typically we want to take money out of the traditional IRA first. This makes sense? The bucket that we want to use in conjunction with the traditional IRA, or maybe second, is that taxable account. And the reason being is that the taxable account, when we pull money out of it, is not always taxed at ordinary income tax, or it's not always 100% of what you pull out. Let me give you an example. Let's say that you bought a stock for $50 and a few years later, the stock is worth $100. Fantastic. You made $50. You've owned it for more than a year, meaning you're going to pay long-term capital gains. But if you sell it and you get $100, that $100 you receive is not all gain. You paid $50 to get that stock after all. So 50 is a return of principal, 50 is a gain. And that 50 would be taxed in long-term capital gains brackets. So you'll see right here that depending on your family and how much income you have, whether you're married filing jointly and all that, will determine whether you pay 0, 15, or 20% on that $50 gain. So this bucket of money, the taxable account, can be very powerful because let's say you take that $100 out, you only have a $50 gain and pay 15% tax on that money, meaning it's a very small tax bill. Does that make sense? So the taxable account has more control for taxes as opposed to that big traditional IRA 401k. But because the taxable account does not ever have to be withdrawn or sold or rebalanced, you don't have to worry about the account growing more than the traditional IRA. Now, this leads us to our last account, the Roth IRA or the tax-free bucket. Now, the Roth IRA is totally tax-free. If you put the money in, it's been longer than 5 years, you're over 59 and a half. Like I said before, there's no required minimum distributions when you hit age 73 with the Roth. So this account is the account that we want to have the most growth in. And therefore, we want to touch it last. So think about this conceptually. If this account has better tax advantages than the traditional IRA or the taxable account, therefore growth matters more in this account. And therefore, withdrawing money from this account would be the last thing we want to do. So Roth IRAs are typically accounts that we touch last. Now, there's a big caveat here. Like I talked about with the traditional IRAs and 401ks and Medicare brackets, if say an emergency arose and you needed to pull out money, but you're bumping up against one of these Medicare brackets or potentially going to be, deep into the next tax bracket, it could make sense to withdraw money from that Roth IRA so that you don't shoot yourself in the foot by paying more for Medicare or even, bumping yourself up into another bracket. Does that make sense? So as you can see, the account type matters so much in controlling your taxes. And so you need to be strategic around which accounts you pull from first. And it's going to be really important because you're trying to minimize taxes not only today, but in the future, trying to avoid those RMDs, higher Medicare costs, etc. And so this is a really tricky part of retirement. But if you nail it, you can save yourself a lot of money. Now, here's the big X factor. We don't know what's going to happen with tax rates. Tax rates are historically low right now. They could go lower, absolutely. They could go higher, right? But the bottom line is we don't know. And so we have to operate within the rules that we have today. And one more thing, I want you to be very careful about what you read online or see here on YouTube, especially from guys like me throwing out numbers that don't apply to your specific situation. Please reach out. I'd love to show you exactly how, based on your scenario, what you're dealing with, which accounts you should take out of. You know, I've thrown out some hypotheticals here today, but they don't relate to you. Be very careful what you read online or what you watch on the internet without actually running the numbers for your specific situation. So I put a link below where you can reach out. Please drop a comment. Please like and subscribe. Would love to help out. I'll see you on the next video.